They don't understand the dollar. They don't think it makes a halfpence worth of difference. It's all about the fundamentals. No, the dollar drives absolutely everything. And if the dollar is declining, that is going to have unbelievably profound implications, which is why, as I've said at the beginning, Jack, I think this is macro's time.
I'm about to have a really special conversation with Julian Brigden of MI2 Partners. Since my beginning in macro, Julian is somebody that I've been following and learning from. Before the tariff news rocked markets, I interviewed Julian and he made multiple big calls on stocks, bonds, credit, and the dollar. All of those calls have worked out incredibly well. Julian's really had his eye on the ball here. So with markets in flux, I want to get Julian back on the show and see how he's thinking about things. Oh, and by the way, Monetary Matters listeners can get a 10% discount to Julian's research service for individuals, MacroCapture. Click the link in the description and use code MM10 for annual membership and MM10Q for quarterly membership. Let's get into it. Extremely pleased to welcome back to Monetary Matters Julian Brigden, co-founder of Macro Intelligence 2 Partners. Julian, great to see you.
Thank you very much, Jack. Lovely to be back.
I'm really glad you're here, Julian. When you were last here in the first quarter, you made some big, bold calls. You said that the US dollar would decline alongside widening in credit spreads and a fall in the stock market and a steeper yield curve. At least that's what you said in your research. I think you are 4 for 4 for that. So that is exactly what has happened. Not only have we had a severe repricing in the risk markets, but it's happened as the US dollar has sold off and weakened against other currencies. As you know, Julian, normally when the risk assets sell off like stocks and credit, the US dollar strengthens. So what's going on? And first of all, congratulations on the call, but what's going on here?
Well, thanks, Jag. It's been a culmination of, as we were talking offline, of sort of many years worth of work when we've looked at kind of the setup in markets. And essentially, is the whole world is invested here in the United States. It's just very simple. I think Bridgewater did some great research recently. They said of every dollar globally that has gone into equities, 70 cents has gone into the US, right? I mean, that's pretty extreme. And what it's done is we've created this kind of, we call it a reflexive cycle in the true Soros sense of the word. So in other words, the purchase of the asset, in this case, let's say equities and dollars by the rest of the world, underpins the fundamentals that justify the price of said assets. And we have kind of three economic fundamentals that requires. So the first thing is that as stocks rise in dollar terms, the wealth effect kicks in, right? And we've seen recently from surveys, Moody's did one, where sort of 50% essentially of all consumption now is coming from the top 10%. I mean, ridiculous. Secondly, we have this effect that we call hyperfinancialization, which is simply that as stocks rise, CEOs hire. As stocks fall, CEOs fire because they're just shepherds of their stock price, right? And that's what they're paid for as the most leveraged member of the capital structure. And so as we've had this rising equity market, we've had this extremely strong jobs market and boosted overall consumption. And then the third economic effect, which is a somewhat sort of mechanical and completes the sort of circle of this sort of reflexive cycle, is that as we've seen, when America tends to do well, we love to spend money, right? Our marginal propensity to consume is like double, say, a European. And that we tend to import quite a lot as well. And so our current account deficit blows out. And that has to be funded 100% by foreign inflows in one way, shape, or form. And so that sucks that money back in, Jack. And so you get this kind of circular reference. And so what it's left us is I think, with the whole world fully invested into US stocks, very long dollars, very, very long dollars. And those dynamics have started to change, right? The Trump administration wants a significantly lower dollar. I think it's not a radical thing, right? We've seen this twice in sort of post-war history. We saw it at the end of Bretton Woods, so in the early 70s, when Nixon imposed tariffs on Japan and Germany to kind of get them to agree to revaluing the dollar down, And we saw it under the Reagan administration in the mid-'80s ahead of the Plaza Accord, which once again got the Germans and the Japanese to agree to a weaker dollar and a policy intervention. So, they want to put a top on the dollar, and they want the dollar to be inherently strong, but just lower. And they're not the same thing, Jack. I want to stress, right? Just because you want a lower dollar, it doesn't mean that you want a weak dollar. You want an inherently strong dollar, right? Economically sound dollar, but you can just have a lower exchange rate. And they want to rebalance this trade deficit. And if there's one thing that I would stress is that people do not understand. And in this sense, Elon Musk is absolutely correct. Peter Navarro is a moron. When it comes to balance of payments accounting, right? This is just double entry accounting. If you run a very large current account deficit, so a trade deficit, you must run a large capital account surplus. And that capital account is mostly funded via foreign direct investment, which the administration wants, and to reindustrialize, and they want more of that. But then there's a lot of portfolio inflows and investment inflows. And so if we're going to shrink the current account deficit, the current account or the capital account surplus is going to decline, which means less money coming into US assets. So that was kind of the setup as we thought things, Jack. We thought that the tariffs were going to be much more aggressive than people certainly initially believed. We thought there was far too much euphoria. And we actually wrote to our clients and we said, we're going to have this sort of 3-stage process on the day of the election. We said, it's going to break some eggs. People don't realize this is going to be much more aggressive. They want to reshape the economy. This is a radical agenda. But we'll go through this phase where everyone will go, they'll assume it just looked like the first administration, woohoo! And then we'll get this kind of confirmation period as all the data picks up and the soft data looks fantastic. And then we'll get to the inauguration. Then we said, reality is going to hit and it's going to hurt. And so in that sense, we've been right. We still think the tariffs, frankly, are even more radical than even we thought. We thought they were going to be much more radical than the market thought, but they're even more radical than we thought. And I'm not saying that any of these things are wrong, Jack, right? I think it's a laudable objective to improve the lot of the vast majority of working Americans relative to the 1% or the 10%. I think it is laudable to reindustrialize from a security perspective, the US. I think it is laudable that you get the rest of the world to pay a bit more of their own share when it comes to defense. I question the tactics. I think the tactics may backfire, but my job is not really to assess whether a policy is right or wrong or politically, justifiable. It's just to figure out the consequences. And I know when I talk to my US friends, and I am in the US, that the views just become incredibly partisan, Jack, right? So we have this silly thing like the Republicans say, well, a University of Michigan consumer confidence survey, that's just totally invalid. And you go, why? Because they give you the breakdown of opinion by voters. I mean, does that make the data invalid? Because you're in there, Republicans are in there. It's just, but you can see the extremes when I think the number for the Democrats now for inflation 1 year out is like mid-6s or something. Maybe I think independents are even higher. It's in the 7s. And Republicans are 0.1, right? Year over year, 0.1. And I'm like, what are we going back into deflation? So I just, my job, and I think that's the saying, I think people's opinions are being driven by their political belief to some extent. And my job is to cut through all of that and just to give you the cold, hard facts as to what I believe will happen in financial markets.
there are people who say, oh, I think Trump is not going to succeed with the tariffs and therefore I'm bearish. You're not saying that. You're saying that even if President Trump is successful in lowering the U.S. trade deficit or the U.S. current account deficit, which includes services
Yep.
and financial payments and stuff, that mechanically will mean that less money from the rest of the world is going to flow back into the United States. And if there's been a lot of foreign direct investment announced from NVIDIA and Apple, that is going to be in the capital surplus account too. So actually outflows or net inflows are going to be even lower into the United States. Julian, tell us about the scale of what we expect. I mean, so far the dollar has weakened. The dollar index, what, 4 or 5%. The U.S. stock market was down as into S&P as much as 17%. Now it's
Yeah.
down 10%. Credit spread widened, but they pulled back a little bit. Just tell us what is the scale of what you expect and how you think things play out from here.
So when we look at the dollar, we think, our models are already suggesting sort of a year from now, like another 10% lower, Jack. They're dynamic models, so they could increase and they only go out like a year. I could see, another 15, 20%, maybe. So we get sort of the euro back into the mid 130s, maybe possibly 140s. You get dollar yen down to 120, sub 120. And I think, that is going to be that's a normal kind of dollar cycle, right? Typically pans out over a number of years. I'm not suggesting it happens tomorrow. I do think that some of the moves are happening quite rapidly. And this is one thing that we've been stressing to our clients. And one thing that sort of worries me, when I look at positioning in the equity market, it looks to me like US domestic investors have just once again aggressively bought the dip, Jack. I mean, one of the things I like to look at some of these ETFs, and you can look at the shares outstanding, and a lot of these ETFs, which tend to be bought by domestics, you can see the shares outstanding have doubled since the election and are now sitting at absolute highs, despite the fact that these guys have lost water. So retail in the US is like fully in. I don't know whether that's a reflection of wealthy retail being more Republican, and so they're fully on board with the agenda. I don't really care. They're fully in. Okay. But when I look at foreigners have had basically, at least a decade plus of gains in the S&P. And they've also had huge currency gains, right? The euro has weakened against the dollar. The yen has weakened against the dollar as they have bought US stocks. So they've had this 2-for-1 trade where they've made out on US stocks and their currency has weakened. So they've made even more. And those gains have been enormous, Jack, right? Enormous. And the inflows have been enormous, right? Foreigners own close to 19 to 20 trillion dollars worth of US stocks, like a third. And Europeans own a very large proportion of that, like almost half of that. So when you look at this, Jack, and you say, if you're a real money account in, London or Paris or Frankfurt, and you've made hundreds of percent in what was a very straight line trade where you probably got incredibly complacent, where if you were a global fund manager, the models were telling you could own even more US stock because they diversified and lowered the overall portfolio risk, because when stocks sold off, the dollar rose. So in your currency, it acted as kind of a damper. And that didn't happen this time, right? I think that judicious profit taking, even before we start to hit on sort of ideas of, is the US the player that you think it was, right? Is it a good ally? Just judicious profit taking, when you've just seen, in the last few weeks, 20, 25%, depending on what currency, of those gains just evaporate, right? I mean, it literally is up the escalator, Jack, and it was just like down the lift shaft for these things. So just judicious profit taking, I think, has to happen. And I think that is why when I look at this setup with US domestic investors, I worry they're getting all enthusiastic and they don't realize there are literally trillions of dollars worth of foreign money to be sold or hedged or whatever, and the money is going to go home. And that's when you, and I'm not, this is something that we were talking about, a few months ago, and we talked about in the first quarter. But now, I mean, if you look at, standard US banks, Citibank, right, just cut their expectations in the US. They double upgraded, I don't quite know what that is, double upgraded Japan, and they upgraded Europe. Right? I was listening to Bloomberg this morning, Invesco, huge global fund manager, sell the US, buy the rest of the world. And the dollar is the linchpin that does that, Jack. And if the administration, rightly or wrongly, I mean, I think there's some very sound logic behind Scott Bessent's policies and the administration. I'm not sure totally the execution has been quite as smooth as we might have liked, but I think there's a sound rationale here. There's just going to be consequences. This is not the time to invest it in tech. This is not the time to be invested in the US. This is absolutely the wrong time. And we haven't had that flush out, Jack. So when I look at stocks, I'm concerned that, look, 20% down was kind of our initial target where we said to clients our retail clients in November, we said, look, our target's like 5,000. And, that was a ballsy call at the time. We've got there. I think you have to come back and fill. Wouldn't be surprised to see maybe a move up to 5,600, 5,700. But I'm a structural seller of US stocks here. And I think until we have that true capitulation event, which could take us down, into the low fours, then this is not over. This is not over.
Yeah, Julian, just to give a sense of the scale from your work, I learned a Norwegian investor, and actually, Norway is the largest sovereign wealth fund in the world. A Norwegian investor who bought U.S. stocks in 2011 is up about 1,000%. Because
at the highs, it was up 1,000%.
At the highs, at the highs, yeah, thank you.
Yeah.
Because the stocks were up 400, 500%, and the currency basically was cut in half against the dollar.
Yeah,
so if you didn't hedge your exposure, a Norwegian investor who bought U.S. dollar, the S&P 500 in dollars, was up 1,000%. So they're just sitting on massive, massive profits.
Yes. Yeah. And just as I said, I mean, just logic would dictate you've had a good run, extraordinary good run. Do you double down here and think you do 1,000% again? I mean, the world just doesn't work like that. Not when you have an administration that is saying to you, the dollar is too high. We want a deal to drive the dollar lower. And when you look at Plaza and you look at the end of Bretton Woods, Jack, I mean, those periods were periods where the US asset markets underperformed their peers, certainly for a US investor, right? So you were better off being in the Nikkei or the DAX, in euros or in yen. Certainly in the first one, you were better off being in precious metals, right? Maybe we can get away with that. I'm actually a big precious metals bull, but just the US and tech. I mean, if you look at the period like 2002 to 2008, Jack, right? That was a period of dollar weakness, right? I mean, wasn't the end of the world, right? We weren't running around going, woe is me. Oh, the US is screwed, right? That was a period of dollar weakness, and it was a period of like literally biblical rotation within the equity market from the prior decade where, we'd had the dot-com bubble, so tech had done exceptionally well, right? Tech just massively underperformed. Energy, which hadn't done anything in the dot-com bubble, massively outperformed from 2002 to 2008, mining, metals, all of the things that people didn't own going into the bubble high. And so even if this is a relatively benign scenario, right? And we were certainly not priced for a recession. Anyone tells you that is wrong. And I'm not saying we're going to get one. I think there are quite significant risks around a recession. But a standard recession, if you look back, you're at 90 years worth of data, and in actual fact, it's been more recently. Remember, it's very big corrections in the equity market, and coming from where we are coming in terms of the hype of where US assets are, I don't think it's impossible, but it's just a standard average correction in US stocks in a recession is 30%.
Mm-hmm.
So I think, we can go quite a long way, but I just think structurally, if I'm talking to my retail clients, it's like, look, guys, if you're positioning your portfolio for the next 5 years, right? It's not going to look like the last 5 years if this is what we are trying to achieve, right? And it looks like the Trump administration is pretty serious about climate change, right? It's a very, very different world.
How are you thinking about the mechanics of how this plays out? Because there is a mechanical way of the lower the U.S. trade deficit is, therefore the lower the capital surplus, and therefore lower asset prices,
Yep.
all things being equal. But the reason the dollar is actually down 8 or 9%. And by the way, the dollar is down 8 or 9%. When I said it was down 5%, I was
Right.
undercounting that.
Right.
Is because basically foreigners have sold, and there's been a migration of money out of from U.S. assets to European and Asian assets. So isn't that kind of a popularity effect in anticipation of the tariffs, right? It's not like 2 weeks of tariffs has caused this massive rotation mechanically. It's just that it's caused a stampede of money out by investor sentiment, right?
Yeah. So I think, as I said, I think that as the equity market is corrected, I think people have realized that they were over their skis. I think as we've had a degrossing in the hedge fund space, the real money is now getting back. They were overweight US, they're now getting back to benchmark to the US. Could they go underweight? I think that's entirely possible, depending on, that's probably the next stage. But I think, the mechanics are quite simple, Jack. I mean, if you look at, if we go into recession, US rates are going to get cut. Now, I'm not saying that European rates are not going to get cut. They are, but this is all relative, right? This is all relative. All the money is here. The current account, I mean, if we go into recession, the current account deficit will shrink. It always shrinks, right? Because Americans don't go on holiday to Santorini, and ruin it for everyone else, on their Instagram posts. But that shift was mechanically, if we go into recession, we mechanically drop it. And so I think what you're going to see, let's take a benign thing. So we just have a slowdown, I think, right? If you have a slowdown and the dollar continues to gradually weaken under this sort of aura of the Plaza Accord is coming, right? I think it's going to take, look, I don't think tomorrow the Japanese and the US are going to walk out and go, we're done. That's it. Dollar yen 120 tomorrow. Wham. Right. I think it's going to take some while to get out there, but the plan is there, right? It's definitively out there. And it's something that the administration wants. And I think in that situation, foreigners are, as I said, are going to gradually just a bare minimum hedge their FX exposure. And given that a lot of equity guys generally don't hedge their equity exposure, probably, reduce it to the US. And people say, well, where does the money go? Well, in many cases, the money doesn't go anywhere because it just evaporates, right? I mean, until it's in your bank account, it isn't real money. It's just a mark on a screen, right? So all those, Norwegians who were up 1,000%. The money's gone nowhere. It's just gone, right? Unless they sold it up 1,000%. Now they're only up whatever it is, 900%, right? Or
Right, Julian,
800.
but if they do sell it, so let's say a Norwegian fund sells NVIDIA and Apple, they suddenly have dollars. What are they doing? Are they keeping it?
So, I mean, if we're talking about the Norges fund, they don't put it back into Norwegian kroner. They put it, their benchmark, I think, is in euros. So they'll probably put it back into euros, right? And I think this is why you are seeing this drip, drip, drip move in the currency. Real money guys who accumulated these positions over decades, right? Decades. Or a decade plus, sorry, a decade plus. You do not flush them out in 10 weeks. Right? These are hundreds of billions of dollars, if not trillions of dollars, that have to get rebalanced, right? And you have these, these TWAP orders where they come in and it's time weighted average price. So they'll give, some bank like X amount of time to buy €1 billion, right? Because we're doing some bond switch or we're doing some, equity switch. And these things just get executed. And you can see it in the markets if you study, if you're a scholar of price action, the euro kind of comes down and then it just goes bump. And you think, oh, it's going to come down. And then it just goes donk, 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 donk. Because there's a big order there just going, thank you, thank you, thank you, thank you.
Getting filled all the way up.
Yeah. And then can we do another billion? Right? I mean, this is a true, if the administration is serious, which I've always believed they were earnest from the day of the election. I've got very good policy contacts who haven't steered me wrong, didn't steer me wrong for the election in 2016. On the night of the election when everything was imploding, we were turning around to our clients saying, buy US stocks, buy US stocks. They're going to spend a lot of money. They're going to cut taxes. It's going to be great. This time we said, no, they're going to push this policy through. And this is going to have truly tangential impacts. I mean, if you look what Scott and the team on the economic side are saying, they want to shift the US economy away from consumption to more of reindustrialization, right? And if that is the case, which, as I said, I think is great if they manage to achieve it, it just has significant consequences. And American investors, I don't think, are really thinking about them, right? I mean, you're moving away from a globalized world where, the likes of Google and Apple and NVIDIA have done exceptionally well. And you're moving to a world where, domestic industrial companies should do better. And the size of that market that's available to some of these global firms, right, shrinks. I mean, to be brutally honest, Jack, if I were the president of the United States, I would call Tim Cook in and I would say, you employ 140,000 people in this country. You pay no tax. How about screw you? I'm going to put 100% tariff on your product. And here's your choice. You move it all back or your tax rate's 30%. And I'm closing down all those loopholes. I mean, this is what people don't understand. I mean, I think, people get wound up about, it's China and then Mexico and they're the evil villains. No, the evil villain is the C-suite of corporate America. China and Vietnam and Mexico are the recipients of decisions that were made in corporate America to outsource, maximize profit, right? They're the ones that screwed middle America. It wasn't the Chinese. I mean, they're a convenient poster child, right? Because you don't really want to say, Tim Cook, you're a villain. But Tim Cook, you're a villain.
The way President Trump frames it can be quite helpful in terms of like he's a little bit funny, but that he says that I don't blame the Chinese. If I was the Chinese, I would have done the same thing because they're getting a great deal.
Right.
Julian, Why we've gone so far, we've barely mentioned the T word tariffs. I want to get into it, but first, for Monetary Matters listeners, you and the folks at MI2 Partners have graciously given a 10% discount to quarterly and annual subscriptions of MacroCapture. Tell us, what is MacroCapture? Why did you build the product? And what does it feature? Why might it interest some of our listeners here today?
So for many, many years, I had a joint product with Raoul Powell, as some of you may know. And then Raoul sort of went sort of all crypto all the time. And I just, the fundamental underpinning of that we were really supposed to be a macro product sort of got lost. And so we decided to go our own separate way. And my philosophy was relatively simple. I think we're in an increasingly macro world. I think this is at a point in history where macro is the driving force. And in that sort of scenario, it just overwhelms everything, Jack, in terms of your portfolio allocations, in terms of your personal financial decisions. And it's quite a complicated space, right? I mean, I've been doing this for nigh on 40 years. It's my birthday this week, and I'm not telling you how old I'm going to be, but it's a big one. And so we're trying to offer, and within the firm, we have some ridiculous number, like 180 years worth of collective experience, because everyone's sort of pretty much my age. And so we're trying to bring this skill set, which has been honed over many, many years in slightly different group, areas, from FX to bonds to equities to so on and so forth, to help clients understand macro so they can start making their own decisions. And then ultimately make them money, right? Make them money. And so, as I said, we suggested, first thing we came out in November when we launched it was, you said to people, you've had a good run. We really think this thing is toppy. We really think you want to be raising some cash. We really think you want to be cutting down some risk. We really like, in stocks, but we really like gold. We really, we advocated buying there. And so it really is to try and help people position and think longer term as well. So it's kind of educate, develop kind of a framework, because that framework is hugely important, because when things are frenetic, if you don't have the framework, if you don't have the thought process, you can make errors. Emotions can get in the way, right? And you can say, oh, look, my gold is down. Oh, it's down $200. I'm going to sell it. But if we think we're going into a weak dollar environment and gold's going to 5,000, then the drop is really, I should just be buying more, right? As an individual investor. So that's kind of what we did. It was really to try to educate people, give them a framework for decision making, and then ultimately make the money. Because I'm not interested in, we do not just want to talk about the economics and stuff like that. I've sat on trading desks the whole of my life. This is just a waste of bloody time.
There are people who the research I really respect and I find valuable for my own process. And I want people to know that it's not like, oh, I'm having so that we can sell a bunch of research. Actually, I mean, there are people who I interview who I would not do this program. Like I'm only doing this with people who I consider to be AAA plus. And, in future affiliate deals, people will see that it is people of very high quality. And I also, two nice things I want to say about you. One, I think you have a trading mind. And for example, even though you had a bearish view, I got a report, we can do a flash it on screen, of 2 days after Liberation Day. So or actually technically 3 days, I guess. It was Saturday. So the market was down 10% in 2 days. You still had a bearish view, but you said, like, look, I think we could totally have a bounce. And then the next week was,
right,
a significant bounce. I think the biggest, 1 week moves in over a year. So I think you have a trading mind, and then also you have actionable calls. Like there are people who are good macro thinkers and economists, but basically like they just write poems, and it's like, what am I doing here? It's a poem to Ray Powell. Like, what's going on here? Like,
right.
I sell. What's your view on HYG? You had a nice HYG put trade. Like that's good. And if you were wrong about that, then that trade wouldn't have worked. But at least it's a call. At least it's a call, and you can have a track record and be held to account. All right, Julian. So just people can get a 10% off, and we'll have a link in the description. Julian, let's now talk about tariffs.
Mm-hmm.
All right. As we record, the tariff rate on China is well over 125%.
Correct.
Reciprocal tariffs on the rest of the world are at 10% floor. In 90 days, they are scheduled, maybe, probably, who knows, to go up to their reciprocal levels. In some instances, with countries with very large trade deficits, very high levels of 40 or 50%. In some instances, countries such that have a trade surplus with the United States, or U.S. has a trade surplus with them, rather, it would be 10%. What is the overall economic impact? You write that you write that we believe the approach to tariffs is akin to carpet bombing, not a precision strike. What is going to be the economic consequence of these tariffs? Walk us through it, please.
So, look, I mean, certainly the initial phase has not been, it's hardly sort of strategic precision execution. It really has been, a tariff for you and a tariff for you, hence the sort of carpet bombing effect. So I think, Jack, look, I think there are three objectives of tariffs, and I think we have to take a step back, and we've been writing about this for a while. So there was a revenue element of tariffs, right? There is a key revenue element in the Senate budget proposal has penciled in $2 trillion of revenue from executive orders, aka tariffs, right? So that, I think, is kind of that 10% baseline tariff. I think there are some strategic objectives, re-onshoring to ensure control over strategic industries that are domestically satisfied. So whether that's semiconductors or pharmaceuticals or whatever, right? And then I think there's the I don't like you, I want to achieve something, I'm going to just bash you around a little bit kind of tariffs, and those are some of the extreme ones. I fear that, I mean, most people have reacted as kind of you would hope they would. So they've done what Scott Percent advocates, so they haven't escalated them. So we've seen a calming down. I fear about China. I think the Chinese are in it to win it. I think they are not going to back down. I do not think they're coming to the table. And I think they are quite capable, and you can see it in what they're trying to do fiscally, of at least sticking this thing out. Now, we can make a decision that 5 years from now they've lost, we've won. But I think it's very naive to assume that they haven't got cards to play, right? When they are the largest provider of savings in the world, right? And we are running a now, as of this morning, like a 7.3% of GDP budget deficit, right? This thing is not going down. It's going up. They've just downgraded what they think they can save from Doge, right? From $1 trillion to 150 billion, right? We are very, very dependent on the rest of the world. But for US consumers and for the US economy, this is bluntly, very simply, initially, and we don't have to think about the good stuff yet, right? The inverse of Ricky Gervais saying, oh, you're still thinking about the bad stuff. We don't have to think about the potential for the good stuff yet. We have to deal with the bad stuff. And this is stagflationary, right? You can see it this morning. If you look at Empire, PMI, prices paid, prices received, it spiked enormously. It's commensurate with PCE being back above 4. And so this is just... this is going to be inflection. It is demand destructive because of that impact on consumers. And so the risk is that consumption will weaken. It is negative for investment. I mean, one thing I really question is, as I said, on this execution side, is unless you create certainty. And look, I think they had various different tariff levers that they could kind of pull. The ones that they've picked are temporary. They could really only run for 6 months. and so AIFA and that sort of stuff. And then that gives them time to complete these longer investigations so that we come to a permanent tariff. So I think this is stagflationary. We're not yet in a recessionary environment, but the mechanics for a recession are really there, Jack, right? I mean, we already had arguably since the third quarter quite a weak labor market. Like, we haven't been hiring many people, right? We haven't fired them, which is great, but the level of hiring just has dissipated. So if you look at lots of metrics of, you were working full time and now your boss comes to you and says you have to work part time, so this thing called part time for economic slag, that number is just steadily, inexorably rising. And that loss of momentum in employment is very dangerous. Employment is definitively a momentum play. And what we've lacked so far is that kind of the 1-2 punch. The two always came from an equity correction. And we didn't have that in the third quarter or the fourth quarter, Jack. We had a strong equity market. And now we've had it. And historically, when you go back like 70 years, that does raise the odds of a recession. And so and I would talk to some of my Republican friends who are pretty aggressively Republicans, and they, came back from some of the meetings in the White House and so on and so forth. And they're like, absolutely, we're going to get a recession. Right now, I think much more of that was assuming some more aggressive cuts around Doge, right? But the mechanics are there, Jack, and I think people are going to be shocked, right, about how high these prices go up. And I think there's this assumption that all foreigners are going to eat it. I don't know whether that's the case, right? I don't know whether that's the case. We live in a world where the corporate sector is kind of profit maximizer. And certainly since COVID, prior to COVID, I think that we lived in this world, and I think this was one of the biggest changes that COVID initiated, where there was a reluctance to kind of raise prices. We kind of got used to a world where you didn't raise prices and you grew market share, or you maintained your market share. And then COVID came along and they went, we can jack prices and we can still maintain our market share, especially in the US, which is a very uncompetitive economy in many sectors of the consumer goods, where economic rent is disproportionate in the corporate sector compared to other parts of the world. So I think the concept that we can rely on the corporate sector to be this benevolent partner that will eat some of the cost, it's laughable. So I think we are going to see quite a big rise in costs come through in the next few months. And I think that's going to be dangerous. And ultimately where we end up, look, I think we'll end up with a baseline of that kind of 8 to 10% rate of tariffs. We raise about $2 trillion. Some countries do deals, they get kind of exempted, maybe, but certain sectors are going to get hit with bigger tariffs. And then we'll have this constant sort of Damocles hanging over anyone who doesn't do what the Trump administration wants, so that he can wake up one day and go, it needs 50% tariffs on you because you've just been a bad citizen.
And so you said $2 trillion. Is that over 4 years?
10.
Over 10 years. Okay, yeah. So
it works out roughly like a 7-8%, depending on how you calculate income, what import substitution would be. So in other words, how much imports would drop as a result of said increase. But yes, roughly a sort of, just for all intents and purposes, you just call it, that is your universal, that comes with a universal tariff, your 10% baseline.
So you say there will be stagflation, which means inflation will go up and nominal growth won't be strong. So adjusted by inflation, real growth is going to be go down. The growth of that is going to go down significantly.
Right.
Inflation is defined as a longer term sustainable rise in the price level, not a one-time price level. If the price of oil triples in a day and then it doesn't do anything from there, that's not really inflationary. That some economists would argue. What Trump administration says that if there are any price increases at all from tariffs, it will be a one-time price adjustment.
Mm-hmm.
What do you think of that theory? And by the way, the Federal Reserve has made some mumblings that it kind of agrees with that.
It's entirely possible. As I said, I'm a little worried about the corporate sector. I mean, it is technically, look, all inflation is a one-time hit because, pretty much because, if you get an oil shock, it's a one-time hit. It goes up once. Inflation is measured year over year. So it's in one year's numbers and then it drops out the following year, right? Now, the problem is from a consumer perspective, if your price goes up 100% one year and then the following year over year and then the following year goes up nothing, the price is still 100% higher actually at the pumps. It didn't rise the second year again. And this is the problem for consumers, right? They're like, oh, inflation's come down, but I'm still paying 25% more for my basket of goods. Yeah, oh, you are, because that happened a few years ago and it's dropped out the number. So the year-over-year rate of change. So I think the issue, Jack, I would say is this behavior, and this is something that the Fed has to be very wary of. To what extent does it get built into a second round effect? Do you start to see it filter into the service sector? Right now, typically, that's what happens. Service prices lag goods prices. Do we end up with said booming economy and we avoid recession? Let's say we just skirt into a period of sort of softest growth, and next year, all that CapEx investment is picking up. Painting a picture, I'm not saying this is my base case, but all that CapEx investment is picking up. Those factories are coming into the US, and unemployment still sitting at 4.3%. And workers are like, well, yeah, I'm still down 25% on my COVID food basket. And then we got another 10% in 2025. And this is 2026, and unemployment's full. And there are no workers to go work in those southern factories. So I'm going to ask for a big pay rise, right? And then that becomes the secondary round effects. It becomes ingrained, and that's something that the Fed has to worry about. So I think it can be a one-off, but I think in the economy that the Trump administration wants to create, this very strong domestic economy, there are significant risks that it may not be quite as transitory as you could think. And sure, prices maybe jump up to whatever the number is, 5-6%, and then they drop back down again, but they ain't going to go back to 2 again, Jap. They get stuck at 3 again, right? Or they jump up to whatever number, But the point is I think this makes the job, the Fed, extraordinarily hard, right? Extraordinarily hard. And that's why I think they really want to kind of sit on their hands and just wait to see, is this going recessionary or is this going inflationary? And then they can kind of move accordingly. Because if we get a recession, it will kill the inflation. That's what recessions do. If we don't get a recession, the odds are it will not kill inflation. And then maybe the Fed will have to make a decision, or if the Fed has been replaced by some flippity-floppity Fed by there because of Donald Trump, then I suspect the bond market will make the decision for the US. But once again, that's further down the track.
So the economic effects of U.S. tariffs in the U.S. is going to be stagflationary, and that
I think that's all we're not even seeing that yet. I don't think we have to complicate this and look too far ahead, and sort of say, oh, it's going to be great in 2026. Let's get through 2025, right? Let's get through that autumn period where typically that's the shitty time of the year for the equity market, right? Let's get through that period. Let's see where we end up, right? And then we can reassess. So I think right here, right now, I'm focused on the stagflationary impact of this. You can certainly see it in the prices. You can certainly see it in consumer confidence. We haven't yet seen it in concrete data, but I think we're going to start seeing it. I think certainly at the high end, there was some comments from, I think it was Hermes, who was saying that the US now is starting to soften. We've seen it from the airlines, right? That premium travel is starting potentially. We've got United tonight. It's going to be very interesting to see what they're seeing. So I think that's the risk, right? You just drop stocks a lot. that wealth effect for that top 10%. It's all about the wealth effect, right?
So the economic consequences are going to be stagflationary in the U.S. What about Europe and China, countries that are the on the receiving end of those tariffs? Europe now 10%, but maybe 20% reciprocal tariffs, and then China currently 125%.
Yeah, I mean, there's no question that that they will detract from growth, but you've seen a response now, certainly courtesy of the fact that the US defense umbrella has been removed from Europe pretty clearly. The Europeans are going to kick up defense spending, so you get this rotation out of exporters into more domestically orientated economies. I think as the money comes out of US equity markets and starts to go into European equity markets, to take advantage of that, that will help to underpin European consumer confidence. But don't get me wrong, Jack, this is, if we go into a deep recession here, and it's not my base case yet, but I think the risks are quite high of a recession. It's not that Europe will avoid it. They will definitely catch a cold. It's just that the money's here, right? And the money's still here. So the money won't stay here. It mechanically can't, right? And then when Japan and China, look, I think China has significant obstacles they've got to go. They've got a very unbalanced economy. We know that's the case. The big thing that they have is they have huge amounts of domestic savings, right? So they can redeploy those, right? God forbid for the rest of the world if they do, because they make up basically 28% of global savings, right? So if we wake up one day and China's said, oh, we're going to do a national health service. Oh, we're going to give everyone pensions to retire, right? And we're going to spend all our savings to do that. The rest of the world's bond markets get eviscerated, right? So I think, don't get me wrong, we are, the other countries will suffer, but because the money is here, and because essentially US exceptionism has been bankrolled by the rest of the world, my concern is we're making these assumptions about our inherent strength of the US consumer and the US economy, not understanding that we're basically at the same time chucking rocks at our foreign banker, right? And I think I've used the analogy, we may wake up and realize that we live in the biggest glass house on the block and we have a big mortgage to the rest of the world.
And Julian, just to connect this idea of the capital account surplus the U.S. has and the current account deficit it has, the Trump administration and particularly Treasury Secretary Bessent makes the argument that because the U.S. is a deficit country for trade and for its current account, that actually it can hurt China more economically. It can hurt Europe more economically, not financially, economically, because imports are a drag on GDP and exports are a boom to GDP. And if the U.S. has way more imports than exports, and then by getting rid of trade, it actually could be GDP positive or be not as GDP negative as it would be for Germany or China. So number one, do you find that argument convincing economically? And number two, what about the case that, okay, maybe sure, the China is going to hurt more economically, Europe is going to hurt more economically than the United States, but China and Europe are the United States' bankers, as you said, and that if they pull money, the financial account, the U.S. will have a much greater account in its much greater tightening in the U.S. financial markets than in the Chinese or European markets. And Julian, guess what? The financial tightening happens really quickly, whereas the economic stuff takes months, if not years. Your thoughts?
The first thing to note, Jack, is we import 50% of our goods, right? So here in the US, so whacking on a whatever the tariff comes down to be ends up being, a big drag on US consumers, right? Germany doesn't export 50% of its products to the US, right? So in that sense, I don't agree. Look, it's possible over time that GDP will rise more here. We will take factories from other parts of the world. They will lose out, all all these sorts of things, Jack. So I think, the jury's out on that one. We've got to create the certainty. We've got to create the environment, and for that money to come back. I think we've created hyper uncertainty, I would say, in the nature of these tariffs, right? If you were a garment producer and you were like, oh my God, I have to get out of Vietnam, now you've just gone, well, I can leave it another 6 months, right? Let 90 days. Let me kind of see, right? So, sure. So I just think this process takes a lot longer than people realize. And what I worry about here in the US is this sort of hyper financialized economy that we are incredibly sensitive, Jack, for our consumption and our employment based upon the equity market. Right? This is what companies do. Companies don't solve for profit. Companies don't solve for earnings. They solve for their stock price, right? I mean, a few years ago, you remember this, we were rewarding companies that didn't make a profit because we didn't want to profit because yields were zero. We just wanted revenue, right? Revenue. Oh, we've discovered this new formula. Well, we discovered it in the dot-com bubble. It didn't work well then, and it hasn't worked well for a lot of these SPAC companies or those sorts of equivalents, right? So I am rather worried that if we're looking at a world where, let's say a relatively benign world, where the US equity market kind of just goes nowhere, it's had a big run over many, many years, as we discussed, and sure, domestics pick up some of the spending, buying of the stocks and foreigners to sell it. Maybe we get away with that. I don't know whether I believe that. Because you're asking Americans to your point earlier, Jack, if the capital account surplus is down and more of it has to go to FDI, foreign direct investment, building factories, and by the way, funding the government, right? Because that money, they're not managing to shrink their need, right? Even less and less goes to equities, which means that if Americans want to keep that equity market rising, they have to drop consumption and raise their savings rate, right? Which wouldn't be good either for the economy, right? I mean, structurally long-term, yes, but short-term, no. I just worry that if we go into, as I said, even a benign scenario where stocks just go sideways, we've seen this sort of game in the past. I mean, CEOs will just go, well, my earnings aren't rising and my stock price isn't going up, so I better cut some costs. And they smash the glass and they reach into that box and they grab that axe, that fire axe, and they just go CapEx and employment. And I think, this is the issue here. I think it's long term, maybe the good things will happen. But I don't need to be focused on that from a market perspective right here, right now, Jack. I hope that that's the case. I hope we pull it off. But I truly, knowing some members of the Trump administration, and particularly some key officials, I know going into this that they thought that these imbalances had to be addressed. They thought that the US had gone past the point where the good, easy choices were over, Jack, right? Where the painless options had gone. And that we're essentially at a sort of devil or the deep blue sea kind of moment, that if we'd have carried on the trajectory that we were, we would have been a faded empire. The dollar would be worth nothing. Treasuries would have been worth nothing. The analogy is always you clipping the corner off the gold coin like the Romans did, kind of thing, like monetary debasement. So now that's the devil. The deep blue sea, I mean, it's the logical choice. It doesn't mean you survive, and it doesn't mean that it's a painless process, right? And I think just listen to what these guys are saying. Wall Street's had it really good. You've done fine. You've had your time. Main Street hasn't. We need to rebalance this, right? Think about what they're saying. Think about, you can argue, well, they won't be able to do it. They might not be able to do it. But if they do it, guys, it means a weaker dollar. It means lower capital account surplus. It means at a bare minimum, US stocks underperform the rest of the world and other assets outperform. And that's really all you've got to think about, right? And stop listening to these talking heads, cheerleaders on CNBC, because it's always about the flow of money and it's always about the dollar.
And Julian, that quote you said of Wall Street's done well, it's time for Main Street to do well. That is a quote from Treasury Secretary Scott Bessent, who is viewed as one of the most moderate voices in the Trump
Correct.
administration when it comes to tariffs. Julian, when you came on Monetary Matters 1 to 2 months ago, you said that you were confident in the outperformance of foreign stock markets over the United States stock markets. And you said there were two ways that could go. Number one is the U.S. assets kind of float sideways to down, and European and Asian markets actually are flat to up. So it's pretty steady. Number two is Asian and European stock markets are down, and the U.S. stock market absolutely falls out of bed. Which option is looking more likely right now?
Well, obviously what we've had is basically the latter. We've had European stocks and Asian stocks up until very, very recently, when I think what we had was just sort of a what's referred to in the market as a VAR event. So you had this sort of degrossing of leverage books as leverage investors were forced to sort of cut all sorts of positions, including their winners. But up until very, very recent, Jack, we've had this absolute outperformance of Europe and Asia as the US has gone down. Which is quite unusual. That's quite unusual to have the US go down as other things really go up. I think, as I said, our initial target on the S&P was 5,000. I want to see how we trade in this bounce. But I really, as I said, I worry, Jack, that we have not flushed really investors out. We had a spike in vol. We've got down all the sort of technical players look like an extreme kind of move. So things have to just sort of settle a little bit here. The dust has to settle. But the underlying flows, I don't think, have changed. And I think depending on how the economy goes, Jack, if we go into recession, in other words, and I think that will dictate the next leg. So if we go into recession, I would expect a down move on the S&P, which takes us probably down about 30%. So you're looking in the fours, and that would be definitely that sort of latter ugly kind of outcome.
And so the foreign stock markets flat to down, just not down as much as U.S. stock markets.
We call it the nice nasty phase, right? So how do you rotate? You look at a divergence, right, between European stocks down here, US stocks down here. How do you narrow that divergence? Well, one of two ways. You go it nice, so European stocks just rise, US stocks go sideways, or you can have it nasty, where these drop really hard and European stocks go down a bit. And this is what we've obviously seen, because this was the one that was owned. US stocks were owned. European stocks were not as heavily owned, right? So you sell what you own. So I still think that there is a significant risk of a nasty correction. And I think that's historically what we do. I think, you go back to the 70s, you go back to the 30s, you go back to the dot-com bubble. I think that risk is still there, but it will depend on whether we go into a recession or not. If we don't go into a recession, we just avoid it, but we get the sort of Plaza 2.0 kind of accord or Mar-a-Lago accord, and we come in and we're intervening to push the dollar thing, then maybe just US stocks just underperform, Americans stop going off to Europe, what you said, that Scott said the other day, that we had the largest number of Americans ever go to Europe versus the largest number of Americans who had to access food help, right? I mean, those are just horrible things. So it's just this kind of a reset, I think is necessary. As I said, I think defines it, Jack, will be, do we go into recession or not? And as I said to you, I think the risks are there. The setup is there. This weakening labor market with an equity correction is very dangerous dynamic, but we need to see it in the hard data. We need to see those layoffs. That's ultimately what will trigger that next move.
And Julian, what about bonds? when stock markets sell off, bonds are supposed to rally, right? But we've seen the opposite,
Yeah.
and maybe it was bonds also that triggered President Trump to soften his tariff views
I
a
think
little
that
bit.
definitively the case, Jack. I think it absolutely was bonds. So as I said, I've been into this business too many years, and I will date myself by saying that when I was at Lehman Brothers, which, in the late 80s, early 90s, we used to have this expression called a sell the US moment. So a sell the US moment was you sold dollars, you sold US stocks, and you sold US bonds. And I've probably seen them 5 times in my career. They generally don't last, Jack, because they demand a response from policymakers. It's like an untenable, the Armageddon out of here kind of Armageddon type move. They demand a response. So I think that's definitively what we saw. And the bond market is just too big, right, to allow that thing to happen. Now, I think it was handy that we got a great 10-year auction where the indirect bidders hit a historic high. Did they have a phone call? But everyone's got levers to play, and I think it would be stupid to assume that they don't use these things. But I do worry that in a world where the dollar is less attractive, where we are not dealing with the fiscal deficit, despite the spin from Doge, it's not happening, where if we go into recession, our needs for funding will rise because the deficit will increase as automatic stabilizers, welfare payments, this sort of thing, unemployment kicks in and tax revenues decline. And where I think, frankly, treasuries are an instrument of confiscation, as indeed they are for most developed bond markets around the world. And I think we also should understand that, Europe is spending an awful lot of money. They're issuing debt. China is issuing a lot of debt to offset its spending. And we're in a world where one of our structural themes, Jack, is that we're in a world of shrinking global savings. And that just means that the general trend for bond yields is up and to the right for the next 20 years. Sure, in a recession, we can go to 3% on your treasury yields. But and as specifically for last week, I mean, we had some leverage degrossing. There were these basis trades, you trade between futures and cash, bonds that came down. We had a VAR event, so hedge funds who were long treasuries, which was quite a popular trade, had to kind of kick those into touch. But did we see some real money sovereign selling? And I think the answer is yes, Jack, because that's when you look at the bond spread, what the bond spread did, say between bonds and 10-year treasuries, it blew out in a way that suggested that far from being up, the euro should have been down against the dollar. And that suggests to me that that was real money going, I'm out of my treasuries, I'm switching into bonds, and I'm doing the FX conversion. And so I do think that it goes back once again to we've been living on the kindness of foreigners, and we've just given them the bird. At best, right? We are kind of acting, I mean, to be brutally honest, like the Sopranos, right? We're just demanding protection money. And the biggest global saver in the world, we've actually launched a true economic war on, right? 100% tariff is an economic war. At the same time, we're tightening restrictions on the export of the technology and all this sort of stuff, right? This is an economic war. And as I said, we have our vulnerabilities too.
And so long term, you said 20 years, you are a secular bear on U.S. treasuries, yields going up, prices going down.
Unless we're going to print the money and buy them ourselves. But that has other consequences, mate.
Yes. So, but on a more shorter term, 6-month, 1-year view, do you have a view?
So I think the bond market is probably from a directional perspective, is one of the harder markets to call because of this which way do we go? Do we slip in? Do we skirt a recession? Do we go into recession? I do think the inflation pulse is coming, so I don't really like the long end bond market. I don't mind being invested if you've got cash in the shorter end of the bond market. And if you're trading the bond market, I'm in favor of steepener. So yields relative, long-term yields versus short-term yields. We've looked at 530s. We think those continue to rise. But the steepener works it's a kind of odd trade, Jack. It's probably a bit esoteric for some of the viewers, but it works in both a recessionary kind of environment and a potentially bond problem, deficit blowout kind of environment. So that's what we like.
You like the steepeners. And Julian, what about gold, which is on an absolute tear?
Yeah, it is. So structurally very, very bullish, secularly very, very bullish on gold, very bullish on silver too. I do warn people that some of the technical targets, some of the technical guys that I really like, if we're talking sort of 125, 150 on say silver, like $1,200 on gold. I worry that, and you get some of the enthusiasts like, whoa, and I'm like, just temper that enthusiasm, because you may not like the world that is necessary to create $1,200, sorry, $12,000 for gold. But we are bullish, Jack. I do worry that if we're going to get another wave of this weakness in equities in the US and more of this risk off, that it's owned now. And so I'm kind of running close stops on my personal positions and looking, and if I get taken out, great. And then I'll look to buy a dip, because I think we possibly could get one to like 2,600, 2,800 again. And then I think at that point you back up the truck. But yeah, it's had a very, very good run. I mean, we bought it at the end of last year, and so we had a very good run on that for our retail clients.
Yeah, that's a great call by you. It's now at 3,200, and so you think that it is short-term overdone, and it could
It's
be
getting overdone, Jack. I mean, look, it's very extended. I think that it's become, we do believe that this is sort of strong hand, weak hands transfer going in, but there's a lot of weaker hands that have recently, so sort of selling from retail into central banks last year. That was kind of the theme, and that's why we were bullish. But those weak hands, that sort of retail and trader money, has come into the trade now and is long. And if we get a shakeout in stocks, if we do eventually break and go lower down to that 4,000 level, I think it's unrealistic to assume that those weak hands won't have to puke the trade out. And so, that's when if you're a long-term investor, you go, thank you very much.
So, Julian, what are you seeing when you're watching the tape that's revealing about who is the buyer or seller of all the assets that we've talked about? You hinted at it earlier. You think you're seeing some selling out of sovereigns because the spread between German Bunds and the U.S. Treasury yields are going in a certain way while the dollar is weakening, when actually most of the time you'd expect that the dollar to strengthen. Okay, give us more market color like that. And can you also talk about the stock market? Is a lot of the selling, the money leaving the United States to go to Europe or Asia, is that from U.S. domestic investors who are overweight the U.S. and are now reallocating, or is it from those foreign investors who were also overweight and now are bringing the money back home?
Yeah. So I think we've suggested to clients that you look at the price action of the sort of S&P in the overnight session. So the cash session runs from 9:30 to 4:15 or whatever it is, US trading hours basically, and that's where most of the domestic execution gets done, and a lot of foreign stuff. But there is this sort of overnight session. S&P's trade all 24 hours a day, and that price action, it can be quite an interesting tell in that overnight session. So if you run into a period which is what we've been seeing, that you open up and the market is weak, then and the dollar, let's say, is soft at the same time in that overnight session, and then domestics come in and go, ooh, it's cheap, I'm going to buy a bit more, and then they sort of rally it up in the trading session. Then the following day, it's just down again on the open, and down again on the open. And then that's, to me, that's real money, foreign selling, selling. And I would caution any US domestic investors to stand heavily against that. I think that's a very dangerous price action for the long-term health and relative outperformance of the US equity market. The currency is very important. It's very, very important, Jack. I mean, we've taken out multi-year trend lines in the euro, dollar Swiss, dollar yen, dollar stocky, blown through these trend lines. Right? So could we go back and test them? I'd love that. I'd love to get that sort of opportunity. But those trends look like they have truly, truly broken. And yeah, I mean, those are the sort of things that I'm watching very, very closely. It's that to see because it's quite hard to kind of figure out. And the other thing, finally, that I want to see is, as I said earlier, I'm looking at some of these ETFs. There's a great one called MAGS. So MAGS is the Magnificent Seven ETF. I'm not sure on Bloomberg. Obviously, a lot of the listeners will not have Bloomberg. You might be able to get shares outstanding. You probably can on some of these other platforms. I just don't use them. Keep an eye on that shares outstanding. As I said, it's risen. It hasn't declined. It's sitting at its absolute high, even though that has dropped. And to me, that's an indication of this sort of commitment. And we saw it in some of the market data. So B of A has that fantastic flow show survey where they showed retail investors like the most active ever 2 or 3 months ago. And these guys have just kept the faith, right? But this is US retail money and they own these shares. Okay, great. I mean, if foreigners were going to buy and they have someone to offload them to as the market rose, but I think foreigners are going to sell. And all right, we technically hit exactly the target that I was looking for on the MAGS thing. We're bouncing. But what if we break through that low? So at what point do you see that capitulation trade? And those are sort of, it's when you look at market dynamics like this, Jack, and it's very important. It isn't just on things like RSIs, because RSIs can remain oversold and in fact or overbought. And that's when you get typically your most explosive moves, right? Just think about, if you're a US investor, just think about what the rest of the world is doing, because it's the rest of the world that's driven the PE multiplication that we've had in the S&P, right? The money goes home, the PEs could go down to 15, right? Don't listen to the analysts on CNBC who are just this US-centric wealth managers, because they never consider the dollar. They don't understand the dollar. They don't think it makes a halfpence worth of difference. It's all about the fundamentals. No, the dollar drives absolutely everything. And if the dollar is declining, that is going to have unbelievably profound implications, which is why, as I've said at the beginning, Jack, I think this is macro's time.
And Julian, your view on bonds, your bearish view on US stocks and stocks in general, and your bearish view on the US dollar. Tell us how you think those views interact with the Trump administration's put or lack thereof on those asset classes. Because with regards to the dollar, it's possible the Trump administration may be actually at your back, because they may have a policy of welcoming, implicitly or otherwise, a weakening of the US dollar. But they certainly don't want bond yields higher. They certainly don't want stocks to crash. Maybe they're fine with stock markets going down a little bit. Tell us, the roughly levels of pain you think in those three assets, bond, stocks, and the dollar, that the Trump administration would be willing to accept before they do a capitulation or a somewhat reversal where, oh, actually, the retaliatory tariff that in 90
Not this week.
Yeah. They'll be actually in 90 more days, or they're 10%. What's the level of pain?
So I think, as we discussed earlier, Jack, I think we saw the wobble, right? And I think it was a combination of that, the sell-off in equities getting down to that sort of 5,000 level. It's a 20% correction, the pretty decent size corrections that we'd sort of seen. And sorry, not 20%, but we were down quite a sizable amount over the lows, not quite 20%. So then we saw the bond market weakness, and I think that's the one that really freaked these guys out. The speed of the moves were just, I mean, Jack, these were insane, right? We did 70 basis points on the 30-year Treasury in like 3 days. Bloody unbelievable, right? So I don't think they care about the dollar. I think, except for the fact I think what they're trying to do is they want to maintain the dollar as the reserve currency, which they absolutely should. But there's a difference between having a high dollar and a low dollar, let me say that, and an implicitly strong dollar where the economic fundamentals support the dollar, and one that, where the dollar is inherently weak and the economic fundamentals don't support that. So to your point, I think that's a given. Now, where's the put? Look, we obviously found the put in the equity market, the short-term put. But if this thing bounces and goes back down, there are not many options that they can achieve. I mean, how do they don't get to, I mean, they can roll back the tariffs, right? But that would mean abandoning their whole agenda, Jack. And I think that's just not good, right? So I think the speed move rather than the level per se, I think in an ideal world, they'd have the US equity market just sit here and go nowhere for the next 5 years, right? But we will see. I mean, as I said, I'm not overly surprised if we go into recession that we could see 30% top to bottom in the US equity market. I think that would be a relatively standard scenario. But at that point, then the Fed put comes into place, and then the Fed is cutting rates, and we get a standard recovery. To the bond market, they have nothing they can do on the bond market, really. I mean, they can shift more issuance to the front end. This is government, right? Treasury. You can shift more issuance to the front end. They can kind of ask some favors around the world. Japan will you show up at the auction, but you can't do that many times. They don't get to control the deficit per se. It looks like they're running into problems in Congress, and getting those spending cuts through, and Doge's expectations of being scaled back. So you're really down to the Fed. So if you got a situation where, what the professional market calls kind of that Liz Truss moment, where the bond market turns around to you and says, no, right? No. You are not running any more deficit. You are not increasing the deficit. We are not interested in buying your paper. And I think we're frighteningly close to those sorts of things, Jack. We wrote about this position where you become essentially, you get what is referred to as fiscal dominance. So fiscal dominance is very simply, central bank typically, inflation, employment, certainly the Fed, most other central banks just focus on inflation. But there comes a point, if you get to a point where the bond market is disorderly and they are not willing to buy your paper, and it's beginning to threaten to some sort of doom loop solvency situation where your banks are under pressure because they own a lot of, we saw this in Italy, right? In the debt crisis in the early 2010s, where the bond banks are under pressure because they own a lot of US treasuries, where there's no bid for the long end because they don't think the US is either good or the dollar's too weak or whatever. So what does then happen is you can get to a point where the central bank is forced to cross a Rubicon where it goes from prioritizing employment and inflation to going to prioritize, as my good friend Mike Taylor talks about, the solvency of their boss, right, which is government. And at that point, you get QE, and the problem is that has other consequences, right? Then the currency, unless other countries are doing it at the same time, gets annihilated. That's when gold goes parabolic. That's when silver goes parabolic. That's even when potentially, and I'm not a huge fan, Bitcoin goes parabolic. But it isn't a world that any of us really want, right? You're playing with the sort of foothills of the sort of Weimar Republic kind, Banana Republic kind of thing, and it would be an appalling place to end up in, right? But you could get there, Jack. You could. It's not impossible to imagine if we do go into recession, for example, that the deficit is increasing anyway, and then the Trump administration is desperate, heading into the midterms to try and boost that economy. So it says, okay, we're rolling over the TCJA, we're pushing through all those other tax cuts that we wanted, and we're not offsetting any of them. And then the bond market goes, what? Right? So it's possible. It's possible.
Julian, we're almost done. I just want to remind our listeners that people can check out your product, MacroCapture, and get a 10% discount if you're a Monetary Matters listener. We got annual and quarterly subscriptions. So the coupon code is MM10 for an annual subscription, and for quarterly, it is MM10Q. So click the link in the description, which is mi2partners.com/macrocapture-landing-page/. That will be, of course, in the description.
Yep.
And then make the decision annual MM10, quarterly MM10Q. Julian, I want to close by asking you about a trade that you put on for you recommended to clients before Liberation Day, which was a put on HYG, 78 put and 75 put, so a put spread.
Yep.
That clearly worked out. Tell us about what motivated you to have that trade, as well as now that it's worked out, and then credit has since rebounded alongside stocks.
Yep.
What is your view on credit now, and how are you viewing the risk reward of, for example, shorting stocks via puts versus shorting credit via puts, or if you're institutional, obviously credit default swaps?
So we've used HYG in the past because it's actually a really nice trading vehicle, because it tends to track sideways for long extended periods of time. That tends to lead to vol getting quite suppressed, Jack. So if you catch it right, and we've got some metrics that we use that have historically worked out quite well. And I will say, actually, we jumped the gun a little bit because we thought it was going to go and it was the right thing to do. But we still don't technically have our sell signal yet. So I think this trade is still embryonic. But what tends to happen is you get these explosive moves. So this is a classic kind of sits here kind of trade, and then wham, right? Or likewise up off the lows. And but after extended periods where you've gone sort of sideways to up for a long period of time, as I said, vols come in and you can create some very nice risk reward option structures. And that's exactly what we did. So where do we stand from here? So we dropped all the way down. I'm sort of looking at it now. We got all the way down to like 75. We bounced back to the 77 and a third or something like that. So I would love it if we could get back to 78 and a half. I would sell more. I would enter the trade. I don't think, unfortunately, you're going to get such good vol entry again. But at this point, you're trading your delta exposure, and you have to on these things on the back of this. And I think the ultimate target is probably around, well, when I say ultimate, I would say my next target is really like 73 and a half, which, is just a trend line kind of off 2020 lows. It's a decent one. Now, if that breaks, then we could have something pretty ugly. You could go all the way to 70, but that's not, this is a way of, we found it as a good way for people to protect their portfolio. It's a cheap protection. The time decay is not bad. It's just a great little trick that and trade that we've used.
Yeah, I think you also did that in 2022, and there I think it worked out because credit spread widened and the risk-free rate went up as well. Julian, if high yield spreads go up a bunch and blow out, what do you think is going to happen to the edifice of private credit and structured credit broadly, which is something that most investors don't really see, but is very important to how deals are done on Wall Street?
So it's a very difficult sector to get any sense of, to your point, of of what's going on. The opacity is very low when you look at that space. But I tweeted out the other day, and I'm deeply suspicious about this desire to get 401k money to be able to buy private equity. I'm not the only one. The OECD came out with a report the other day where they talked about how higher interest rates have tracked a lot of private deals. I'm very worried as well by some of the steps in the Trump administration around college endowment funds. These guys are big users of private equity. And, there was this comment about taxing Harvard. I'm not saying that's the wrong thing. I actually think kind of they should be taxed. I've got friends who've gone there and they said they've just run out of things to concrete over and they just knock down buildings and rebuild them again. So don't get me wrong. I think there's some justification in that, just as I think there's some justification for Apple to pay some taxes. But, all of this stuff has sort of consequences. So I'm actually quite worried by the private equity space. If we are moving into an environment where they just can't offload these deals. I mean, I think people forget that private equity in a kind of a way is the gift that can keep taking. So, every year you can get a call from your private equity guy and saying, we need another 100 grand, right, against your deal. Or, well, obviously not if you're Harvard, it's many, so then you have to sell what you can and what and it's once again, it's emblematic of this assumption, which was never our assumption back in to 2014 and 15 and 16, that negative interest rates were here to stay and we could just finance stuff forever. And we were just saying, the cycle, we're at the lows, this is it, right? If it hadn't been for COVID, I don't think the low in bond yields would have been in 2016, Jack. So in a way, we kind of lucky. I mean, that's the wrong way to put it, but you got that next down pulse only simply because of COVID. And I think the trend in global interest rates is, as I said, is up and to the right, and the consequences of that, I don't think people have got their heads around. I still think there are people, Raoul still believes that we're somehow going to get, back to those sort of lower levels and that we're following some Japanese model. And I think it's fundamentally wrong. I think, we could get back there, as I said, but it'll be because central banks will have to come and cap yields, and that will have other consequences.
Julian, it's been an absolute pleasure getting you back here on Monetary Matters. People want to find out about how they can get that 10% off to MacroCapture. Click the link in the description, and remember, use the codes MM10 for annual and MM10Q for quarterly. Julian, just what do people, when they get MacroCapture, tell us what they get, like the reports, how long they are, and how often they come out, just so people
So it's a sort of, there's typically a report a week. We'll do flash updates as to when we think something is important. We put one of those out. Just to remind people when we got down towards that sort of 5,000 level, that this is where we thought it was going initially. And, it's a combination of our sort of structural views of the world. So to give you that framework so you can think and start to develop your own knowledge, and some of those trading kind of views, and some of the views that we are looking at. We're not offering a portfolio. We're not giving you the perfect sort of portfolio, in terms of specifically, how you have your asset allocation. We don't go into the 60-40 sort of stuff, but, we really want to emphasize and teach people how at these true inflection points, Jack, which come about every, 5-10 years, just now is the time to be doing this. And we have chats, we have videos. We tend to keep it internal. I think there's a lot of people like yourself who are getting lots of people on, and we'll be trading. We'll surely be, as I said, the big thing is beyond this education process. It's and showing you the charts and the things that we're watching at is actionable trades, right? Which I can't give away on things like, your show, because that are Monetary Matters, right? I can talk about the framework, but there's a big difference there in actually making the money.
definitely. But we could do the HYG thing that you already.
You
put.
can definitely. I'll give you that one for free.
Yeah. All right. We appreciate that. Julian, thanks so much for coming on Monetary Matters. Thank you, everyone, for listening. In addition to, of course, checking out MacroCapture and the associated deal for Monetary Matters, listeners, remember to check out the show on YouTube. Please subscribe if you don't already, as well as on Apple Podcasts, Spotify, wherever else you find your podcast. And also, please leave a rating and review. It really helps the show. Thanks again, Julian. Until next time.
Thank you, Jack. Very, very excited.
Thank you. Just close the door.